Ever felt like the world of finance, especially something as complex sounding as futures and options, just throws this wall of jargon at you?
Happens all the time.
Or maybe you're just fascinated by how these super high-speed markets actually work, behind the screens. Well, you've landed in the right place. Welcome to the deep dive.
Today, we're really digging into futures and options trading. You've given us some fantastic sources covering, well, everything from how exchanges work to the really crucial safeguards that protect the market.
And our mission, like always, is to boil all that down, to distill that comprehensive material into the most essential insights for you.
Yeah, think of it as your shortcut.
Exactly. Your fast track to understanding this dynamic, tech-driven, and actually very carefully regulated world where futures and options come alive. We'll try to unearth some surprising bits and connect the dots.
So you walk away feeling genuinely informed.
That's the goal. Okay, let's jump right in.
Yep.
How has trading itself changed? I think most of us have this image, maybe from old movies.
Oh yeah, the pits.
Right. Traders in a chaotic pit, shouting, using these frantic hand signals. That whole open outcry market, it looked so, I don't know, raw and physical.
It absolutely was. A place where bids and offers happen face to face. But fast forward to today, and that landscape, almost entirely electronic.
And what's really interesting here is that in a market like India, futures and options trading is fully electronic, like 100%.
Screen-based, yeah. And very transparent, runs on sophisticated, automated systems.
It's such a leap, isn't it? From the physical pit to this powerful software. And it highlights a key idea. For any contract, futures, options, even shares to be traded efficiently on an exchange like this, it needs to be standardized.
That standardization is absolutely key. It's what makes this kind of digital high-volume trading even possible.
Okay, so building on that, to really get this ecosystem, we need to know who the main players are.
Exactly. Think of them as different layers of service providers in this pretty intricate financial network. So at the base level, you've got the trading member, the TM.
That's basically your broker.
Typically, yes. Your brokerage firm. They're members of the stock exchange, and they can trade for clients like you or for their own account, proprietary trading. Each TM has a unique ID, and they can have multiple users operating under that ID.
Okay, so the TM is my direct contact. But what if a firm wants to do more than just place trades?
That's where the Trading Come Clearing Member, or TCM, comes in. This is a TM who also has the capability to clear and settle trades.
So handle the money and the finalization.
Precisely. Not just for themselves and their clients, but also for other trading members and even institutional players called custodial participants. It's a much more integrated role.
Interesting.
And then you have the Professional Clearing Member, or PCM. Now, what's distinct here is they are not trading members.
Oh, okay, so they don't execute trades.
Correct. These are often big banks or custodians. Their whole purpose is clearing and settling trades for their associated TMs and institutional clients. They just focus on the post-trade mechanics, the nitty-gritty of settlement.
Right, the plumbing of the market, almost.
Kind of, yeah. And finally, there's the self-clearing member, or SCM. Like a TCM, they are a trading member, but they only clear their own proprietary trades and those of their direct clients.
So they don't clear for other brokers.
Exactly. They keep it in-house. And the people or companies actually placing the trades through all these members, we just call them participants, the clients. You might trade through different TMs, but settle everything through one single clearing member.
Makes sense. And you mentioned a regulatory change about sub-brokers.
Yeah, that was significant. Back in 2018, the SEBI mandated that all the old sub-brokers had to transition. By April 1st, 2019, they either had to become authorized persons, or APs, operating under a TM, or become full trading members themselves.
What was the goal there? Streamlining.
Pretty much. Streamline the structure, but still allow brokers to expand their reach through these AP networks.
Okay, so with all these different players, it brings up a really important point. What does my trading member actually owe me? What are their responsibilities?
Good question. And they're pretty extensive, actually. All designed to protect you, the client. It starts with KYC, know your client documentation, formal agreements.
The paperwork.
Right. But also ensuring your orders are executed promptly, making sure you maintain adequate margins. Crucially, keeping your funds separate in dedicated client bank accounts.
So my money isn't mixed with theirs?
Absolutely not. Timely pay-in and payout of funds and securities. Issuing contract notes detailing your trades without delay. handling complaints properly, and maintaining a unique client code for all your transactions.
Wow, that's quite a list. It sounds like a very regulated relationship.
It is. It's built on a foundation of investor protection and transparency.
Okay, now let's peek behind the digital curtain of a typical trading firm. You mentioned hierarchies within their software.
Yeah, within their trading systems, there's a clear user hierarchy. It dictates who can see what and do what. At the very top, you have the corporate manager.
The big boss.
Essentially, yes. This role has the widest view, the most power. They can place orders, view trades, pull reports for all branches and all dealers across the whole firm.
And they set limits too, right?
Critical function. The corporate manager defines exposure limits for different branches. It's a key risk control point for the entire firm. Below them, you've got the branch manager.
Makes sense. They oversee their own branch.
Exactly. They can see orders and trades for all the dealers within their specific branch, but not other branches.
And at the bottom.
That's the dealer. Their access is the most restricted. They can only see their own orders and trades, no visibility into what other dealers are doing, even in the same branch.
What's layered? For accountability and risk, I guess.
Precisely. It's fundamental for managing internal operations and risk effectively.
All right, let's dive into how we actually interact with the market. Through orders. Trading members enter these orders with different conditions, right?
Yes, various conditions that control how and when they get executed. First up, time conditions. The simplest is a day order.
Just good for the day.
Exactly. Valid only for the trading day it's placed. If it's not filled by market close, poof, it's automatically canceled.
Okay, what else?
Then there's the immediate or cancel order, IOC.
Sounds urgent.
It is. As the name says, you want this executed, or at least part of it, as soon as it hits the system. Any bit that can't be matched immediately is instantly canceled.
So you might only get a partial fill.
Very possible. You take what you can get right now, and the rest just vanishes.
Okay, now what about price? Price conditions.
Right. A limit order gives you price control. If you're buying, you set the absolute maximum price you'll pay. If selling, the minimum you'll accept. It only executes at your price or, better.
So you might not get filled if the market doesn't reach your price.
Correct. It prioritizes price over certainty of execution. A market order is the opposite.
Get me in or out now.
Pretty much. You tell the system, buy or sell at the best available price in the market right this second, whatever that might be. Speed and certainty of execution are key here, not the exact price.
Got it. And then there's the really interesting one, the stop-loss order.
Ah, yes, incredibly important. This is a core tool for managing risk, for limiting potential losses.
How does it work exactly?
Okay, so a stop-loss order isn't active right away. It only becomes active when a specific price level you set, called the trigger price, is reached or crossed.
So if the market moves against me and hits my trigger,
Then bang, your order activates.
Uh-huh.
And it enters the market either as a market order or a limit order, depending on how you set it up initially.
could you give an example?
Sure. Let's say you buy shares at RS 100. You want to limit your potential loss. You could place a stop-loss sell order. Maybe you set the trigger price at RS 95.
Okay.
And you might also set a limit price, say RS 92. So if the share price drops and hits RS 95, your sell order is triggered. It then goes into the market as an order to sell at RS 92 or better.
Ah, so it caps the damage if the price falls sharply.
Exactly. It helps prevent a small loss from turning into a catastrophic one if the market moves strongly against you. Very crucial tool.
Okay, so you place your order. How do they actually get matched up in the market? In India, you said it's an order-driven market.
Yes, order-driven. This means orders are matched automatically by the exchange's computer system based on what's called price-time priority.
Price-time priority, meaning?
Best price gets priority, always. The highest buy order will always match with the lowest sell order. Simple as that.
And if there are multiple orders at the same bed's price?
Then time decides. The order that was entered first gets executed first. First come, first served at that price level.
You get partial matches, too.
Oh yeah, very common. Your order might be filled in bits and pieces as matching counter orders become available.
It sounds like a pretty complex algorithmic dance happening constantly.
It really is. All designed for fairness and speed.
But what about stopping things getting too crazy? Preventing extreme volatility? You might think derivatives have fixed price bands, like stocks do sometimes.
That's a common assumption, but in India, derivative segments typically don't have those traditional static daily price bands.
Oh, so how do they manage big swings?
They use something more dynamic, operating ranges and day min or maximum ranges. For example, Index and stock futures might have a dynamic 10% range calculated from a base price. Options are even more sophisticated. Their ranges are specific to each contract based on its delta value and updated daily.
Delta-based.
Right.
Okay, that's getting technical.
Yeah.
But the point is, it's not a fixed cap.
Right. It's more about preventing, obviously, erroneous entries and providing some boundaries without completely halting price discovery like a hard band might.
Okay, so this raises a really interesting question then. How do regulators ensure stability without those rigid caps?
Well, what's really insightful here is seeing how regulations adapt, how they get enhanced to make markets safer. SEBI, India's regulator, actually brought in significantly enhanced criteria for these dynamic price bands recently. There was a circular on May 24, 2024.
Recent changes. What did they do?
They're designed to clamp down on those really sharp, sudden price jumps or drops that can destabilize things. For instance, to increase a price band, they call it flexing. It used to take just 25 trades involving 5 unique traders on each side.
Okay, seems reasonable.
But now, much tighter. It requires 50 trades, 10 unique traders, and this is critical, 3 different brokerage firms on each side, the buy and the sell.
Whoa, so that makes it much harder for a small group to just push the price up or down.
Exactly. It essentially makes it way harder, maybe nearly impossible, for a small group or cartel to artificially manipulate the price band. It needs much broader market participation now. That's a big shift towards fairness.
Okay, what else?
Another key change. The price bands for futures contracts now move in lockstep with the underlying stock's price band in the cash market. If the stock hits its circuit limit and its band adjusts, the futures band adjusts simultaneously. Keeps things aligned.
Makes sense. Consistency.
And there's significantly more cooling off time built in now before prices can move further after hitting a limit. If a stock keeps hitting its limits, the required breaks before the band can increase again get progressively longer.
How much longer?
Okay, so for the first 2 5% rises, it's a 15-minute break, or just 5 minutes if it's near the market close. But for the next 2 potential 3% rises, it's a full 30-minute break.
30 minutes. That's substantial.
It is. And for any further 2% increases after that, a whole 60-minute break is required. This gives traders much more time to assess, react, and prevents these runaway moves from just spiraling.
Slows things down deliberately.
Right. And there's another crucial detail, sliding price bands. This is neat. If the upper price limit moves up, say from 110 to 115 in our earlier example range of 90 euro of 10,
Yeah.
the lower limit also shifts up proportionally, so it would move from 90 to 90 euro of 5.
So the whole range slides up. It doesn't just expand outwards.
Exactly. It prevents these extreme one-sided scenarios where the price can only go up or only go down within the band, forces a more balanced potential movement.
Clever. And options get limits too during these cooling periods.
Yes, during a stock's price limit cooling off, temporary limits get applied to its options contracts as well.
Okay, so let's tie this all together. What's the big picture takeaway for the listener here?
The takeaway is really about market stability and fairness. These enhanced rules are all aimed at reducing those sudden, jarring price jumps, making it much, much harder for small groups to manipulate prices, giving you, the trader or investor, more time to react, and ultimately making price movements smoother, more predictable. It's about building a fairer, more stable, and more trustworthy market for everyone involved.
That makes a lot of sense, a more robust system. Okay, now let's briefly touch on what a trader actually sees. The behind-the-scenes experience, the workstation.
Right. I mean, describing it only goes so far, but typically you'd see various windows. A title bar, naturally. Ticker windows showing prices scrolling by for futures, options, the underlying cash market stock.
The live feed.
Yeah. A toolbar with function buttons. A market watch window where you track specific contracts you're interested in. Inquiry windows to get detailed quotes. A snap quote for a quick price check. And of course, the crucial order entry and trade book windows. System messages pop up too.
A lot of information streams converging.
It is. Seeing a live screen really brings it to life more than just listing the parts.
And when orders are actually put in through these systems, there's a specific tagging requirement.
Yes, important for transparency. Trading members have to identify every order. Is it pro, meaning for their own proprietary account, or CLI for a client? And if it's client order, your unique client account number has to be attached.
Accountability. Tracking every trade back to its source.
Absolutely crucial for market integrity and oversight.
Okay, moving on. Who actually gets to play in this market? Let's talk eligibility. Not every stock can have futures and options traded on it, right?
Not at all. There are pretty strict criteria for both stocks and indices. The main goal, to ensure that only large, liquid, and crucially not easily manipulable stocks and indices are available for derivatives trading.
Makes sense. You don't want derivatives on some tiny, easily pushed around stock.
Exactly. So for individual stocks, they have to clear some specific hurdles and maintain them continuously for 6 months. They need to be in the top 500 by average daily market cap and average daily traded value.
So big and actively traded already.
Yes, but it goes deeper into liquidity. They look at something called the median quarter sigma order size, or MQSOS.
MQSOS, what's that measure?
It basically measures market depth,
Yeah.
how much money you can trade buy or sell without significantly impacting the stock's price. A higher MQSOS means a deeper market. For derivatives eligibility, this needs to be at least RS 75 lakhs.
So big enough orders won't cause wild swings.
That's the idea. Stability is key for derivatives. Also, its market-wide position limit, the MWPL, that's the maximum total open interest allowed across everyone, must be substantial. At least RS 1500 crores.
Huge numbers.
They reflect the scale needed. And its average daily delivery value in the cash market actual shares changing hands needs to be at least RS 35 crores.
Okay. And if a stock fails these tests later on?
If an existing derivative stock fails to meet these criteria for 3 consecutive months, then no new monthly contracts are issued for it. Existing contracts can still trade until they expire, though, and once a stock gets kicked out, it has to wait a full year before it can even be considered for re-inclusion.
A timeout penalty box.
Sort of, yeah. Ensures only consistently eligible stocks remain.
And then SEBI added something else, a product success framework, PSF.
Yes, this is quite interesting. This isn't about getting in. These are additional exit criteria applied after a stock's derivatives have been around for at least 6 months. It's about demonstrating ongoing success and relevance.
So use it or lose it.
Kind of. It requires that, on average each month, at least 15% of all active trading members, or 200 TMs, whichever is lower, must have actually traded in that stock's derivative contracts.
Wow, so it needs broad participation.
Exactly. Plus, trading in those derivatives must happen on at least 75% of the trading days during the review period, and it needs to maintain healthy turnover, average daily turnover of at least INR 75 crores, and significant open interest, average daily notional open interest of at least INR 500 crores.
Okay, so the insight here is SEBI is saying it's not enough just to qualify initially. These derivative contracts need to be actively used, liquid, and relevant to a good chunk of the market participants on an ongoing basis.
Precisely. If they don't meet these ongoing usage metrics, they get delisted from the derivatives segment. It keeps the market focused on robust, active contracts and weeds out illiquid ones.
Makes sense. What about indices? Similar logic?
Similar logic, slightly different criteria. For an index to have derivatives, at least 80% of its underlying stocks, by weight, must be individually eligible for derivatives trading themselves.
So the index is mostly made up of eligible stocks.
Right. And no single ineligible stock within the index can have a weightage of more than 5%. These checks happen monthly. 3 consecutive failures. No new contracts introduced for that index.
Okay. And does the PSF apply to indices too?
Yes, except for the main flagship indices. For other indices, the PSF also requires ongoing activity. 15% of active TMs, or 20 TMs, trading on 75% of days, minimum average daily turnover of INR 10 crore, and minimum average daily open interest of INR 4 crore. Again, ensuring liquidity and participation.
It's a pretty comprehensive approach, and this leads to a concept you mentioned, a surrogate or pseudo-index. What's that about?
This is a clever workaround, really. Imagine a primary index is under review and maybe just barely fails one of the criteria temporarily. Instead of just stopping derivatives trading on it, regulators allow an alternative index to be used as a surrogate under strict conditions.
To keep trading going.
Exactly, to maintain market continuity. But the conditions are tight. The smaller surrogate index of stocks must make up at least 80% of the primary index of stocks. There needs to be at least a 50% overlapping constituents between the two.
So they have to be very similar.
Very similar. And critically, the price correlation between the two indices must be extremely high, at least 0.90 over the previous 6 months. And each exchange can only designate one such pseudo-index.
So it's a backup plan, but a very carefully controlled one?
Precisely. A pragmatic solution for temporary hiccups.
Okay, let's switch gears now to something that happens all the time. Corporate actions. Stock splits, bonuses, mergers. How did these affect futures and options contracts that are already trading?
This is absolutely critical. When a company does something like this, it directly impacts the value or structure of its shares, so the derivatives based on those shares need to be adjusted.
Why adjust?
The fundamental principle is to keep the value of your position the same before and after the corporate action. Your relative status, like whether your option is in the money or out of the money, shouldn't change just because the company split its stock. The goal is neutrality.
Okay, so what gets adjusted?
Primarily, three things in your contract: the strike price, your position, the number of contracts you hold, and the market lot or multiplier, how many shares one contract represents.
How's it done?
It depends on the action, but it's usually done after market hours on the last day. The stock trades come benefit, meaning the last day with the upcoming benefit attached.
Okay, like for a stock split or bonus.
Right. For common things like bonuses, say A shares for every B shares held, stock splits, A new shares for B old shares, or even consolidations, reverse splits, they use an adjustment factor.
A formula.
Yeah, a simple one. For a bonus AB, the factor is A plus BB. For splits consolidations AB, it's just AB. This factor is then used systematically. Your strike price gets divided by the factor, your market lot gets multiplied by the factor, and your total position, the number of contracts, also gets multiplied by the factor.
So everything balances out to preserve the original value.
That's the intent. For rights issues, it's a bit more complex, involving calculating the theoretical benefit per share from the rights offer, which then feeds into an adjustment factor. But the goal is the same: neutralize the impact on derivative holders.
What about dividends? They happen all the time. Do they trigger adjustments?
Good question. Only extraordinary dividends do.
How do you define extraordinary?
SEBI defines it as a dividend that exceeds 2% of the stock's market value. If it's less than 2%, it's considered ordinary, and no adjustment is made to the derivative contracts.
And how do they figure out that market value?
It's usually based on the closing price of the stock on the day before the dividend was announced. If a dividend is extraordinary, only the strike prices of the options and futures are adjusted downwards by the dividend amount per share.
Okay, so small dividends, no change. Big ones, adjust the strike. And what about major events like mergers or demergers?
Those are handled differently. If the underlying company, the stock itself, ceases to exist because of the merger or demerger.
Like it gets absorbed or disappears?
Right. Then all the existing futures and options contracts on that stock are compulsorily settled. They're closed out based on a determined settlement price on the last day it trades with the old identity, the last come date. And importantly, no new contracts for that disappearing stock are introduced after that.
So that just brings those positions to an end.
Effectively, yes. A clean break.
Now let's shift gears again. This is something everyone encounters. The cost of actually trading. It's not just the price of the future or option itself, is it?
Not at all. Understanding the total cost of participation is really crucial. There are several layers of costs involved.
Okay, break it down for us.
Broadly, you can think of them in categories. First, user charges. This is mainly your brokerage, the commission your broker charges you.
Which can vary a lot.
It can, often lower for intraday trades versus overnight positions. Depends on the broker's service level, too. Also, under user charges are exchange transaction charges. Exchanges charge brokers a small fee on trades, and brokers typically pass this on to you. It applies on both buy and sell sides, and for options, it's calculated on the premium value.
Okay, brokerage and exchange fees. What's next?
Then you have statutory charges. These are government levies, taxes, and fees. The big one you might hear about is Securities Transaction Tax, or STT.
STT, how does that work?
It's a small percentage, but applied differently depending on the transaction. Sellers pay it on the option premium when they sell options. Buyers pay it on intrinsic value when they exercise options. Sellers pay it on the futures traded price when they sell futures. The rates are small, like fractions of a percent.
Okay, so STT. What else statutory?
You've got Goods and Services Tax, GST, currently 18%, and it's applied on top of your brokerage and the exchange transaction charges.
Tax on the fees.
Exactly. There's also a very small stamp duty, usually paid only by buyers of equity futures and options, and tiny SEBI turnover fees that fund the regulator. The key here is these are generally small, percentage-based costs, but they add up.
Right. Anything else?
Yes, one more interesting category. Investor Protection Fund Trust, IPFT charges.
What's that for? Sounds important.
It is. This money goes into a fund set up by the exchanges. Its main purpose is to compensate investors if, heaven forbid, a trading member defaults and can't meet their obligations. It also funds investor education programs.
So it's like an insurance fund for the market.
In a way, yes. The charge is minuscule on the NSE, for example. It's like 10 per crore traded in equity futures, or 50 per crore of premium value in equity options, plus GST. Tiny, but contributes to a crucial safety net.
Okay, so those are the explicit fees and taxes, but you mentioned other costs, hidden ones.
Yeah, these aren't line items on your bill, but they definitely impact your trading results, especially for active traders. We're talking about the bid-ask spread and impact cost.
The spread, that's the gap between the best buy and sell price.
Exactly. The highest price someone is willing to buy at the bid and the lowest price someone is willing to sell at the ask. If you want to trade right now, you have to cross that spread. You buy at the higher ask price or you sell at the lower bid price.
And that costs you money immediately.
Right. Even if the underlying market hasn't moved, say you buy an option at 16.80, the ask, and immediately decide to sell it, and the bid is 16.60. You've instantly lost 0.20 per lot just from crossing the spread.
And the spread is bigger for less liquid things.
Much bigger, usually. For very liquid contracts, the spread might be tiny, but for less actively traded ones, it can be significant. Impact cost is related. It's a measure of how much the price moves against you because of your own trade, especially if you're trading a large size relative to the available liquidity. You impact the market.
So these are real costs, just not explicit fees.
Absolutely. They represent the cost of immediacy and liquidity.
Can we see how this all adds up? Maybe with that example you had. A short index future position.
Sure. Let's say you short one lot of an index future at a price of 17,500. The lot size is 50 shares, so the total contract value is Rs 8,075,000.
Okay.
Now, let's estimate the costs. Brokerage might be, say, 0.03%, which is Rs 262.50. STT, paid by seller on futures, at 0.01% is Rs 87.50. Wait, the outline says 0.02% STT for future sellers, value Rs 175, let's use that. Exchange fees, maybe around Rs 17.5. SEBI charges, IPFT charges, maybe a rupee or so combined. You're looking at a total cost of around Rs 507.47 for that one trade just on the sell side. Now remember, brokerage rates can be flat fees these days, much lower sometimes, and stamp duty is usually only on the buy side. But it gives you an idea that these costs, while individually small, accumulate.
Definitely something to factor in. Okay, let's unpack a huge topic now. Algorithmic trading.
Mm-hmm.
Algo trading. The machine's taking over.
Well, it's certainly a dominant force. At its core, algo trading is just executing orders using automated, pre-programmed computer instructions.
So coded strategies.
Exactly. These instructions consider tons of variables: price, timing, volume, maybe news feeds, other market data. It's basically a mathematical model running on a computer, adapting to market conditions in real time.
And the big advantages are?
Two huge ones: speed and removing emotion. Algorithms can react to market changes and execute trades far, far faster than any human possibly could. We're talking microseconds. This speed enables high-frequency trading, or HFT, where firms might make tens of thousands of trades per second.
A mind-boggling speed.
Right.
And no fear or greed driving decisions.
Correct. It executes the predefined strategy consistently without human emotional biases interfering.
Who uses this mainly? Big institutions.
Primarily, yes. Institutional investors, large brokers, proprietary trading firms. They use it to optimize execution, manage large orders, capture tiny price differences, arbitrage. However, in markets like India, some retail clients, usually through larger brokers, are also allowed to use certain types of algo strategies.
But with all this power and speed, there must be concerns. Regulation.
Absolutely. SEBI, the regulator, is very aware of the potential issues. They've specifically put out warnings cautioning investors about unregulated platforms that aggressively push algo trading strategies.
Promising huge returns, I bet.
Often, yes. Promising unrealistic high returns, mis-selling strategies. So SEBI has taken steps. They've explicitly told brokers, you cannot make claims about past or expected returns from any algorithms or strategies, and brokers cannot associate themselves with any third-party platforms that do make such claims.
Trying to curb the hype and protect investors from scams.
Exactly. It's a clear effort to ensure responsible use and marketing in this very powerful, fast-evolving space.
Okay, moving on to staying informed. How do traders actually track all this F&O data? It must have changed massively over the years.
Oh, dramatically. Think about it. Decades ago, you were relying on the daily newspaper to see yesterday's closing prices.
Right, waiting for the financial pages.
Now, it's all real time, instantly available on exchange websites, broker platforms, financial data providers. You can track everything.
Like what specifically? What are the key data points?
Well, the basics: Date, symbol, the specific instrument, future, call, put, expiry date, option type, strike price, any corporate action flags, and of course all the price points. Open, high, low, close, last traded price, volume traded.
And open interest. That's a big one for derivatives.
Huge. Open interest tells you the total number of contracts still outstanding, not yet closed out. For futures, it's often shown as the number of contracts. For options, sometimes just the number of contracts, sometimes a notional value. You can also see total traded quantity for the day, total traded value, and even the number of individual trades executed.
So a ton of raw data. How do people make sense of it? Look for trends.
Exactly. Traders constantly monitor trends derived from this data. Things like, who are the top price gainers and losers for the day? Which futures contracts are seeing the biggest increase or decrease in open interest? That can signal where new money is flowing or positions are being unwound.
Looking for where the action is.
Right. Which specific call options or put options are most active by volume or open interest? And a really popular indicator, the put-call ratio, or PCR.
PCR, how's that calculated?
Simple division. You can calculate it based on the trading volume, total put volume divided by total call volume, or based on the open interest, total put OI divided by total call OI.
And what does it tell you? Market mood.
Generally, yes. A high PCR might suggest bearish sentiment, more people buying puts for protection or speculation, while a low PCR might suggest bullishness, more call activity. Traders interpret it in different ways, but it's a widely watched sentiment indicator.
Okay, finally, let's talk safety nets. What happens when technology fails? Glitches happen.
They do. Systems aren't infallible. And that's where things like the Investor Risk Reduction Access Platform, or IRRA, come in. This is really interesting.
IRA, what is it?
It's a joint platform set up by the stock exchanges themselves. Its specific purpose is to give individual investors a way to manage their positions if their trading member's website or platform goes down due to a technical glitch.
So if my broker's site crashes, I have another way out.
Exactly. It's an alternative access route designed as a backup when both the broker's primary site and their disaster recovery site fail. A last resort, almost.
Okay, how does it work? Can I place new trades?
No, that's key. IRA is not for initiating new positions or trades. It's specifically designed to allow you to square off or close your existing open positions or cancel any pending orders you might have in the system. Risk reduction, not new trading.
Got it. Just managing existing risk. And it's only for individuals.
Yes, explicitly for individual investors, not for institutional clients or those using algorithmic trading systems. When a member reports a glitch and requests IRA activation, the exchange notifies eligible investors via email, SMS, and public notices. The trading member also gets an admin terminal to monitor things.
That sounds like a really practical safety measure.
It is. It addresses a key vulnerability in a tech-dependent market.
And SEBI has a broader framework for glitches, too.
Yes. Beyond IRA for investors, there's a framework for how brokers themselves must handle technical glitches in their trading systems. They have strict reporting requirements.
Like what?
They have to tell the exchange immediately within 1 hour if they experience a significant glitch. Then send it a preliminary incident report the next day, key +1. And within 14 days, a full root cause analysis or RCA report.
Detailing everything.
Everything. What caused it, what the impact was, and crucially, what corrective measures they've taken to prevent it from happening again. SEBI really emphasizes the need for brokers to have adequate system capacity planned in advance to prevent these issues in the first place, especially with more and more investors coming online.
Proactive measures, too.
Yes. They've even set up a centralized portal called ISPOT Integrated SEBI Portal for technical glitches for reporting. And there's something called LLAMA, an API-based logging and monitoring mechanism to help brokers proactively monitor their own system health. It's all about building resilience.
Okay, one last area of continuity planning. What about major outages, like if an entire exchange had a problem, especially in segments where products trade on multiple exchanges like equity derivatives?
Right. SEBI has thought about that too, especially for these interoperable segments. The framework provides ways to maintain market continuity. For products that trade on multiple exchanges, like common stocks or index futures on both NSE and BSE, there's a key mechanism.
What's up?
If one exchange has an outage, participants can use the other exchange as an alternative venue. They can hedge their open positions from the affected exchange by taking offsetting positions on the working exchange.
Ah, so you can neutralize your risk using the other market.
Exactly. It allows positions to be netted off, which also releases margin requirements tied up on the affected exchange. A very important mechanism.
What if a product only trades on the exchange that has the outage?
Good point. For those exclusively listed scripts or derivatives, the framework allows other exchanges to potentially create reserve contracts. These would be backup contracts, specifically designed to be activated or invoked only during an outage at the primary exchange.
Standby market, almost.
Kind of. And if there's an index derivative, say, that doesn't have a well-correlated counterpart on another exchange, regulators might even encourage the exchanges to create new correlated indices specifically to provide these hedging avenues during potential outages.
So they're really thinking ahead about potential failure points. Is there a protocol for triggering these plans?
Yes, it's quite defined. The exchange experiencing the major outage has to inform the designated alternative venue and SEBI within 75 minutes of confirming the impact. The alternative venue then has just 15 minutes to invoke its business continuity plan.
Fast response times needed.
Absolutely. It's a complex, multi-layered strategy designed to keep the market functioning and protect participants even when facing significant technical disruptions.
Wow, okay. That was a seriously deep dive today. We've really covered a huge amount of ground in the world of futures and options.
We certainly did, from the old trading pits to today's electronic screens.
Right, we traced that evolution. Then we got into the surprising complexity of who's who in the trading world, at TMs, TCMs, PCMs.
The different roles they play.
And the equally complex world of order types, limit, market, IOC, and that really crucial stop-loss order for managing your risk.
Definitely key tools to understand. We also spent time on those dynamic new price band rules.
Yeah, understanding how SEBI's trying to make markets fairer, more stable, reducing those crazy jumps, giving people time to react. That was fascinating.
And the eligibility criteria, ensuring only robust liquid stocks and indices get derivatives. Plus, how corporate actions get handled through adjustments.
Don't forget the costs. Brokerage, STT, GST exchange fees, and those hidden costs like the bid-ask spread. It all adds up.
Very true. And the rise of the machine's algorithmic trading, its power, and the regulatory caution around it.
Plus those vital safety nets, the IRA platform for when your broker site glitches, and the whole framework for business continuity if an exchange has issues.
It really paints a picture of a market that's constantly evolving, technologically advanced, but also heavily focused on regulation and investor protection.
Absolutely. This deep dive, hopefully, has equipped you with a much more comprehensive understanding. You've got the mechanisms, the safeguards, the tech that underpins these complex markets.
So the final thought to leave you with, what does all this mean for you? Maybe consider how this relentless push in finance for more transparency, for systemic resilience, for robust investor protection, especially in complex areas like derivatives, how that reflects a broader trend.
How might those principles adapting quickly, building in multi-layered safeguards, demanding transparency, how might they apply or be useful in other parts of your life?
Right.
Especially where you face, information overload or sudden unexpected changes. Something to think about.